Finance is the study and practice of managing money, currency, and capital assets. It is a broad field that encompasses personal, corporate, and public finance. Financial activities take place in financial systems at various scopes. Assets are bought, sold, or traded as financial instruments, such as currencies, loans, bonds, shares, stocks, options, futures, etc. Assets can also be banked, invested, and insured to maximize value and minimize loss. In practice, risks are always present in any financial action and entities. A broad range of subfields within finance exists due to its wide scope. Asset management, money management, risk management, and investment management aim to maximize value and minimize volatility. Financial analysis is the viability, stability, and profitability assessment of an action or entity. In some cases, theories in finance can be tested using the scientific method covered by experimental finance. Some fields are multidisciplinary, such as mathematical finance, financial law, financial economics, financial engineering, and financial technology. These fields are the foundation of business and accounting. The early history of finance parallels the early history of money, which is prehistoric. Ancient and medieval civilizations incorporated basic functions of finance such as banking, trading, and accounting into their economies. In the late 19th century, the global financial system was formed. In the middle of the 20th century, finance emerged as a distinct academic discipline separate from economics. As outlined, the financial system consists of the flows of capital that take place between individuals and households, personal finance, governments, public finance, and businesses, corporate finance. Finance thus studies the process of channeling money from savers and investors to entities that need it. Savers and investors have money available which could earn interest or dividends if put to productive use. Individuals, companies, and governments must obtain money from some external source, such as loans or credit, when they lack sufficient funds to operate. In general, an entity whose income exceeds its expenditure can lend or invest the excess, intending to earn a fair return. Correspondingly, an entity where income is less than expenditure can raise capital usually in one of two ways: by borrowing in the form of a loan, private individuals, or by selling government or corporate bonds, by a corporation selling equity, also called stock or shares, which may take various forms, preferred stock or common stock. The owners of both bonds and stock may be institutional investors, financial institutions such as investment banks and pension funds, or private individuals called private investors or retail investors. See financial market participants. The lending is often indirect, through a financial intermediary such as a bank, or via the purchase of notes or bonds, corporate bonds, government bonds, or mutual bonds, in the bond market. The lender receives interest, the borrower pays a higher interest than the lender receives, and the financial intermediary earns the difference for arranging the loan. A bank aggregates the activities of many borrowers and lenders. A bank accepts deposits from lenders on which it pays interest. The bank then lends these deposits to borrowers. Banks allow borrowers and lenders of different sizes to coordinate their activity. Investing typically entails the purchase of stock, either individual securities or via a mutual fund, for example. Stocks are usually sold by corporations to investors so as to raise required capital in the form of equity financing, as distinct from the debt financing described above. The financial intermediaries here are the investment banks. The investment banks find the initial investors and facilitate the listing of the securities, typically shares and bonds. Additionally, they facilitate the securities exchanges, which allow their trade thereafter, as well as the various service providers which manage the performance or risk of these investments. These latter include mutual funds, pension funds, wealth managers, and stockbrokers, typically servicing retail investors, private individuals. Interinstitutional trade and investment and fund management at this scale is referred to as wholesale finance. Institutions here extend the products offered, with related trading, to include bespoke options, swaps, and structured products, as well as specialized financing. This financial engineering is inherently mathematical, and these institutions are then the major employers of quants. In these institutions, risk management, regulatory capital, and compliance play major roles.